Hi there, I'm Scott Baade, and today we're going to look at when refinancing your mortgage might make sense. With interest rates fluctuating, you could potentially save thousands by locking in a lower rate, and if not a lower rate, a lower payment on all of your debt. This video will cover the key factors to consider when exploring refinancing.
Refinancing your mortgage can be a great way to improve your financial situation, but timing and your unique needs play a huge role in deciding if that's the right choice. Let's break down some of the key factors to think about so you can feel confident in your decision. First, take a look at current interest rates. Are today's rates lower than the rate on your current mortgage? Even a small decrease, like just 0.5%, can mean significant savings. For instance, if you're refinancing a $500,000 mortgage, lowering your rate just 0.5% could save you $167 a month and almost $60,000 of interest over the life of your loan. That's a lot of money that could go back into your pocket. Lowering your monthly payment is another major reason to refinance. If you're juggling high-interest debts like credit cards or student loans, refinancing might help you consolidate those into one manageable payment. A cash-out refinance could also let you tap into your home's equity to cover big expenses like medical bills or home improvements. Plus, reducing your monthly payments can free up cash for other priorities like savings, investing, or just making day-to-day life a little easier. With credit card interest rates around 20 to 30%, this might be a wise choice. Think about the terms of your loan too. If you're ready to pay off your home faster, switching from a 30-year mortgage to a 15-year term might make sense. Not only will you pay off your home sooner, but you'll also save a ton on interest. On the other hand, if lower payments are your goal, extending your loan term could help, though it's important to remember that you'll likely pay more interest in the long run. Now let's talk about stability. If you have an adjustable rate mortgage or an ARM and you're nervous about rates going up, refinancing into a fixed rate loan can give you peace of mind with consistent payments. And if you built up at least 20% equity in your home, refinancing could also help you eliminate private mortgage insurance, cutting your monthly payment even further. Your credit score can make a difference as well. If your credit has improved since you got your original mortgage, you may qualify for a lower interest rate or better terms. Refinancing could be a smart way to take advantage of the progress you've made with your finances. It's also important to factor in costs of refinancing. There are closing costs to consider, usually between 1 and 2% of the loan amount. To see if refinancing makes sense, calculate your break-even point. For example, if refinancing costs $3,000 and lowers your monthly payment by $200, it will take 15 months to recoup the costs. Planning to stay in your home longer than that? The savings could add up. What if you don't want to pay for a refinance? We also have no closing cost options. The rate is slightly higher, but you can start saving money in the very first month, so it becomes a no-brainer choice. Lastly, think about your life and financial goals. Maybe you're planning for a growing family, pursuing new career opportunities, or just looking to build more financial flexibility. Refinancing could help you tap into your home's equity for big expenses like home improvements, college tuitions, or even starting a business.
Refinancing isn't a one-size-fits-all solution, but with the right information, you can determine if it's worthwhile for your unique situation. Contact me for a free mortgage analysis. We'll walk through the numbers together so you can make the most informed decision.